Your mortgage payment isn't buying you a house. It's renting you the illusion that you own something while 7 men designed a system where money itself is debt and you were born into the bill. November 1910. 7 men took a private train to an island off the coast of Georgia under fake names. They represented 1/4 of the world's wealth. In 9 days, they wrote the blueprint for a machine that would turn every dollar in your pocket into someone else's claim on your future. That machine is still running. You are inside it right now. This isn't about taxes. This is about something earlier. A system where money doesn't exist until someone borrows it into creation, and the interest on that loan can never be repaid because it was never created in the first place. You don't escape by earning more. You escape by seeing the trap. This trap has a name, debt-based currency, and it was designed on an island by men who needed you to never understand what they built. The average American will pay over $400,000 in mortgage interest alone across their lifetime. Not the house, just the interest. That's before credit cards, before car loans, before student debt. $700,000 paid to service debt on money that didn't exist until a bank typed numbers into a ledger. You're not paying back money someone saved. You're paying rent on the privilege of using currency. Here's what they understood. If you control who creates money, you control everything that money can buy. If you make that money borrowable only through debt, you guarantee someone will always owe someone else. Always owe. If you charge interest on that debt but never create the money to pay the interest, you ensure the debt can never be fully repaid. Default isn't a bug, it's a feature. Before 1913, the United States had tried this twice. The first bank, the second bank. Both central banks controlled by private interests. Both shut down by presidents who understood the danger. Andrew Jackson killed the second bank in 1836. He called it the greatest threat to liberty. Not foreign armies, the bank. Because whoever controls the money supply controls the future of every person who uses it. Jackson survived an assassination attempt. The gun misfired twice. Statistically impossible. For 77 years, America operated without a central bank. Then came the panic of 1907, a crisis that looked like chaos but smelled like design. J.P. Morgan orchestrated the bailout. He decided which banks survived. When it was over, the public was told America needed a central bank to prevent future panics. The crisis that justified the solution was created by the same men who offered to solve it. Create the emergency. Offer the cure. Install the control. November 1910, Jekyll Island, Senator Nelson Aldrich, his daughter married to John D. Rockefeller Jr., Frank Vanderlip, president of National City Bank, Henry Davison, senior partner at J.P. Morgan, Charles Norton, president of First National Bank, Benjamin Strong, Paul Warburg, partner at Kuhn Loeb, representing Rothschild interests. These men controlled the financial spine of America. They met in secret because they knew the public would never accept what they were building. They used code names, worked for 9 days, writing legislation, structuring a central bank that looked public but operated private. The Federal Reserve System was the compromise. Regional banks that appeared decentralized but answered to a board influenced by the largest banks, control dressed as oversight. This brings us to stage 1. Establish currency as a loan, not a resource. Before the Federal Reserve, money had to be backed by gold or silver. After 1913, money became a promissory note. When you borrow from a bank today, it doesn't hand you cash from deposits. It creates a digital entry. New money. The loan brings money into existence. When you pay it back, the principal disappears, but the interest remains as profit. Money is loaned into existence, and when repaid, it vanishes, but the interest was never created, so it must come from another loan. The total debt is always greater than the total money supply. The game requires losers. Then comes stage 2. Make borrowing feel normal. 30-year mortgages became standard after the Federal Reserve. Debt was rebranded as investment, as the American dream. You don't rent, you own, except the bank owns. You're paying rent with a promise that in 30 years, you'll own the asset. But 30 years of interest means you paid for the house twice. The loan extracts maximum value while transferring maximum risk onto you. Stage 3 is where the system turns. Expand the types of debt available. Car loans, credit cards, student loans. Each new debt product is marketed as access, as freedom. But every loan grows total debt in the system, because the money to pay interest doesn't exist. The system requires constant borrowing just to service existing loans. The Federal Reserve's job is not to protect you. It's to protect the flow of credit. Stage 4. Make saving pointless. Inflation is built into debt-based currency. When banks create money through loans, the money supply grows. More money chasing the same goods raises prices. The Federal Reserve targets 2% inflation annually. Your money loses half its value every 35 years. Saving is punished. Borrowing is rewarded. The system pushes you toward debt because debt feeds the machine. Stage 5. Ensure the debt is never paid off. Refinancing resets the clock. You pay interest on interest. Minimum payments ensure you pay interest forever, while principal barely moves. Credit card companies want you to carry a balance indefinitely. The profit is in the interest. The deeper you fall into debt, the more expensive debt becomes. The system extracts maximum value from those with least leverage. Stage 6. Normalize financial emergencies, healthcare costs, unexpected repairs, job loss. Medical debt is the leading cause of bankruptcy in America. Not because people are reckless, because the cost of care is designed to be unpayable. One broken leg costs $15,000. One cancer diagnosis, hundreds of thousands. You can't save enough, so you borrow. The emergency becomes a trapdoor into a debt cycle that takes decades to escape. If you have a mortgage, you're in stage 2. Credit card debt puts you in stage 4. If you've refinanced, you're in stage 5. Medical debt means stage 6. Most people are in multiple stages simultaneously. You are not failing. You are performing exactly as designed. Here's the business model. Banks create money when they issue loans. That creation costs them nearly nothing. The Federal Reserve allows them to lend more than they hold in reserve. Fractional reserve banking. For every dollar deposited, a bank can lend $10 or more. They create money they don't have. You pay it back with interest using money from someone else's loan. The interest is pure profit. If you default, the bank seizes your collateral, a real asset purchased with imaginary money. They can't lose. The men on Jekyll Island understood debt isn't just obligation, it's control. If you owe money, you need to keep earning. You need to stay employed. A population in debt is a population that can't afford to rebel. Debt is obedience converted into financial structure. The interest ensures that obedience is permanent. This pattern isn't new. In the 1920s, buying stock on margin became popular. Borrow 90% and put down 10%. When borrowing stopped, prices collapsed. The debt remained. JP Morgan bought assets at pennies on the dollar. The Great Depression transferred wealth from many to few. The Federal Reserve had been operating 16 years. It didn't prevent the crash. It enabled conditions that made the crash profitable. In the 1970s, credit cards became widespread. They made impulse purchases frictionless, separated the pleasure of buying from the pain of paying. People spend 30 to 50% more using credit instead of cash. The average household now carries over $6,000 in credit card debt. At 18% interest, that's over $1,000 yearly in interest alone. Profit on money that didn't exist until you swiped the card. In the early 2000s, subprime mortgages exploded. Lenders approved loans people couldn't afford. Adjustable rates started low, then spiked. When people defaulted, homes were foreclosed. The Federal Reserve bailed out banks, created trillions through quantitative easing. That money went to financial institutions first, inflated asset prices. If you owned stocks, you benefited. If you only had wages, you fell behind. Another debt implosion. Wealth transferred from many to few. The Federal Reserve is not a government agency. It's a private consortium of banks under government charter. Regional reserve banks are owned by member banks who earn dividends. When the Fed sets policy, it affects those banks' profitability. The system is designed by bankers for bankers. You are not the customer. You are the product, your labor, your debt, your compliance. Thomas Jefferson warned banking institutions are more dangerous to liberties than standing armies. Lincoln issued debt-free currency during the Civil War to avoid borrowing at interest. He was assassinated. James Garfield spoke about controlling money supply. Assassinated. John F. Kennedy signed Executive Order 110, authorizing Treasury to issue silver certificates bypassing the Federal Reserve. Assassinated. Lyndon Johnson quietly revoked the order. Every leader who challenged central banking faced removal. Do you have a mortgage? You're paying interest on money created when you signed the loan. Credit card debt? You're paying interest on purchases made months ago with money that didn't exist until you used the card. Student loans? Interest on an education whose value hasn't kept pace with debt. Car loan? Interest on a depreciating asset. The car loses value. The debt does not. Here's the mechanism. Money is created as debt. The interest is never created. Total debt always exceeds money supply. The system requires perpetual borrowing and guarantees someone will always default. This is not a flaw. This is the foundation. Designed on Jekyll Island by 7 men who needed you to never ask this question. What do you do? Rule 1. Minimize debt exposure. Every loan is a claim on your future income. Treat borrowing as last resort. If you have high interest debt, pay it down aggressively. Rule 2. Understand inflation is theft. Your savings lose value by design. Convert it into assets that hold value. But avoid assets you must borrow to acquire. Rule 3. Recognize the system profits from your financial illiteracy. Learn how money is created, how interest compounds, how loans are structured. Financial education isn't taught in schools because educated borrowers are less profitable. The silent phase is the period between signing the loan and realizing the interest will cost more than the principal. That's when the trap closes. Most people never calculate total cost. They focus on monthly payment. Can I afford $400 a month? Yes. Can I afford it for 30 years plus $150,000 in interest? Different question. Nobody asks because the payment is manageable. The trap is invisible until you've been inside it for years. The system depends on your exhaustion, your distraction, your belief that this is just how things are. The moment you see the structure, it loses power. You stop making decisions based on what you can afford monthly and start making decisions based on total cost. You stop viewing debt as normal and start viewing it as dangerous. This shift doesn't require wealth, it requires clarity. The men on Jekyll Island built a machine that turns your labor into their profit by making money itself a form of debt, by ensuring interest could never be repaid, by structuring incentives so borrowing felt like opportunity and saving felt like stagnation. They did it in secret because they knew the public would reject it. You were born into this system. You didn't choose it, but you can choose to see it. This isn't about anger, it's about accuracy. The system is not broken. It's functioning as intended. You are not failing. You are responding predictably to incentives placed before you. But predictable doesn't mean inevitable. The game is rigged, but you can stop playing on their terms. You can refuse the 30-year mortgage, avoid the credit card trap, prioritize freedom over status. These aren't easy choices, but they're your choices. And the system can't function if enough people choose differently. If this opened your eyes to the cage you are living in, subscribe. Because in the next video, we dismantle the rest of the illusion.